Welcome to the Multifamily Investor Nation podcast. With us today is Chris Pomerleau and Colin Schwartz. Welcome, gentlemen, to the podcast.
Thank you very much. Thanks for having us.
Thank you, Dan.
Well, I want you to get us started before we dive into this 48-unit property out of Omaha, Nebraska that's called the Vincent. And before we dive into that acquisition, I want you to first kind of go back and forth and tell us a little bit about your backgrounds and where you are right now in regards to the multifamily side of things.
Yeah, I can go first. So this is Chris Pomerleau for those that are just listening and not watching. Born and raised in the Omaha area, actually in Council Bluffs, Iowa, which is a suburb of Omaha, Nebraska. Went to undergrad in Sioux Falls, South Dakota, and then went to law school right here in Omaha. I was in the military in 2010, and then I've been practicing law since 2013. I've also been investing in real estate since 2013 and started the way most people do, just single family homes, typical BRRRR method that everybody uses. And after about 4 successful refis and rolls, if you will, on the single family, I was curious if I could do that on a 2 or a duplex. And I was curious if I could do it on a 20 unit. Then I was curious if I could do that on an 80 unit. And that's really just kind of the trajectory that we've taken here. So now we've gone full cycle and pulled out 100% of our capital on refinances 43 times. So we've done multifamily exclusively since 2017 and currently out of over 1,000 units. 70 million assets under management, and Park Ave Capital is the name of the group Colin and I started, and that consists of me, Collin Schwartz, and Steven Sykes.
All right, I'll jump into a little bit about my background. This is Colin Schwartz from New Mexico, basically. Graduated, bachelor's, moved out to Nebraska, Omaha, Nebraska, started kind of the corporate life, went through, got the 9-to-5, started working as an analyst, working in IT. Thought I made the end goal for everybody. You find that great, 6-figure job, you're consistent, you're getting benefits. You see that, at 65, you're going to hit this retirement goal and you've made it. Well, January 1st, 2017, I read the book Rich Dad, Poor Dad, and I realized that I wasn't making it, that I was dying a slow death in my cubicle and was not getting ahead. So pretty much immediately, I just started educating myself, read just pretty much every piece of content that came out, bought a 3-plex, quickly after bought a duplex. Honestly, since then have not gone more than 24 hours without having a project under contract. Soon after, met Chris. I formed Bricktown Management, which we're now all partnering on, which is a property management company, and then founded Park Ave Capital. And as Chris said, about 1,000 units. We have, another, I think, 450 or 500 units or so under contract all over the Midwest. We're in Tulsa, we're in Sioux Falls, we're in Kansas City, Des Moines, and then Omaha is kind of our home base.
Awesome. Well, let's go ahead and dive into this acquisition called the Vincent. You guys acquired this one about 15 months ago now. And the unique thing about this particular property is that obviously this one has increased in value. So we've increased the value. I say y'all have increased the value. I'll use that kind of Southern slang, if you will, since I'm over here in Columbia, South Carolina. We increased the value of this property by $1.3 million in a very short period of time. So let's go ahead and dive into this asset first. And let's first talk about how you acquired this asset, meaning like more or less like what did you do to find this asset and get it actually to the point of being able to put an offer on it?
So this is right around the time where we were really picking up a lot of traction. Those 1,000 units we've accumulated over the last 3 years. And so when we picked this up 15 months ago, we were smack dab in the middle of just really catching a lot of traction and just getting noticed by a lot of the local brokers and community investors and whatnot. With this deal, it fell through with the first person that had under contract, and it fell through because they couldn't get financing. And so I had a friend who was a part of the brokerage that had it originally locked down on the sales side. And he informed the selling agent. He said, look, if you want someone who's going to actually close on this, they built up a lot of traction recently, you need to take it to these guys. And so I appreciate my friend for reaching out to us, and they just wanted someone to close. And so we actually found it, if you will, off market. No one really knew about it because it had already gone on a contract. And even when it was on a contract that time, it was off market. So we didn't have to really deal with a lot of the sharks, which is great because we honestly would have probably had to pay more. So it came to us off market from a selling agent.
So do you know why it fell out of contract so many different times in the past? Was it kind of a hairy deal?
No, actually, and I'm sorry if I made it sound like that. It only fell out of contract once, and it fell out of contract that one time because that one buyer could not get the financing to close on the deal. And it wasn't that the lenders didn't like the project. The project makes sense all day, but I guess I'm not privy to whether that was because the buyer didn't have the financial statement to back it up or couldn't raise the funds. And now that I'm saying it out loud, I think what it was is that it was some type of syndication JV where they couldn't raise enough funds to close. And so they brought it to us. Okay.
And how many, so by the time you actually got it across your desk, how soon after that did you maybe put your first offer on it, or maybe even when actually and toured the property?
Yeah. So we move quick, right? It has helped us, and I'll continue to do this as long as as long as we can. But if somebody sends us something that's viable, that's possible, certainly off market, we're getting an offer out in 24 to 48 hours. Whether it's an LOI or an actual offer, that's going to depend upon the situation. Now, if it's no disrespect to, actually, I won't make any big names here, but some of the big brokerages, if I get some mass email, I'm not going to be sending out offers in 24 to 48 hours. And if it's gobbled up by one of those main people that we all know, they're going to want more than makes sense anyway. But on this, I wanted to show that seller, and like we always do with our deals, especially off market deals, we want to show that seller we're here, we're ready to roll, and you can trust on us closing. So we put an offer in within 24 to 48 hours.
And at what point did you end up touring it?
I don't recall the exact, within 72 hours. So unfortunately, I don't recall whether we actually walked it first or not. I know that we put an offer before we even saw the property, but we knew of the property. We knew of the area. Colin lives right by there. It's a very nice area, Class B asset in a Class A neighborhood. It just wasn't being managed correctly. And we knew all about the asset. So we didn't need to see as much of it as you would think.
So after you submitted this kind of first initial offer, did they go ahead and accept that offer? Or was there kind of a little bit more of a back and forth that went there?
Yeah, we brought them down about $150,000 from what they wanted. Okay. They wanted 3.3. We got it for 3.13.
Okay. And so walk me through a little bit about the due diligence phase here. So anything that came up during due diligence that might be interesting to kind of, talk about and cover?
I could soak up this entire time. I don't want to talk for Colin, but I can just, some of the initial situation that we went through, just the walkthrough of getting to know the tenants, getting to know the units, seeing how much work had actually been done on the property. It was relatively, it was unfortunate what the property looked like, what the units looked like. And it was because the seller at that time just deferred maintenance. They weren't updating the units. I mean, this is a great area of town. And, throughout that due diligence, we needed to see the properties and see every single unit, which we did very quickly. And we just saw that because there's a deferred maintenance, because they weren't updating the units, then they were getting rent that was much below market. They were getting the clientele that is much below what you'd want. And that's all because they weren't taking care of the property.
Yeah.
And just to seller?
No, he's actually in state. So
okay.
Personally actually know him, and they kind of, they're really good at getting cash flow and kind of juicing the property, but they're not as much of value add investors. I mean, something that you look for and which you can see pretty quickly as you walk through the property, the hallways are kind of a mess. The lighting's terrible. There's light bulbs out. You're seeing that there's no smoke detectors. You're seeing that honestly, the odor of the property is not the greatest. That's kind of the actual due diligence of the physical property. No landscaping, the lighting was poor. I mean, the courtyards were pitch black at night. Pool area was just peeling paint. Just a lot of different things. It's just like, okay, this is a nice neighborhood, surrounded by really nice homes. There's pretty simple maintenance that wasn't really attended to. You start getting into the financial due diligence, you're like, oh, they're paying for all the utilities here, the owner, except for electric. All right, so they're just eating that cost. Then you look, there's a big discrepancy in who's paying what rent. So you see they may be getting close to market rent on a couple, but the majority of them aren't near market rent. So that's another thing as part of due diligence in which we see, we're like, okay, there's that delta there, and why? Well, they're getting, $795, $895, whatever for a unit that looks exactly the same as the unit that they're getting $660 for. So that was also part of the due diligence, which made it seem like that there was going to be a lot of upside to the project.
So walk me through a little bit about the actual business plan on this particular property.
Yeah, I mean, look, we could get really nitty gritty, but for the most part, this is a bread and butter value add play. We've discussed that it's just not, it wasn't up to the status that it should be. It was a lot of deferred maintenance and just wasn't a very nice environment. So the units need all to be updated. That obviously allowed us then to demand the rents that we wanted. And we were raising about 25%, Colin, if I'm not mistaken. 25% was the rent raise. The utilities, the water, sewer, gas, those were not being paid for by the tenants. So now we're charging back to the tenants. We're charging common area maintenance fees. And really just with our properties, the numbers make sense to a lot of people, whether it's our investors or whether it's obviously discussing this on podcasts or whatever. The numbers make sense. Raising the NOI, cap rates in your favor, the property is now worth more. But the way we've always been successful is that we start off with great management right away. We come in and before we say, surprise, we just bought it yesterday, your rent's going up $300. We come in, we don't only touch the rent, and we just start fixing the things Colin discussed, the common areas, being receptive to the request, the deferred maintenance. And so that really was our game plan from the beginning, was to show them that we're going to take care of the place and going to answer all your needs that perhaps haven't been answered recently.
So as far as the unit upgrades, so I don't want to get into too much of the weeds, but I do like to get into some of the weeds just a little bit, because I know that's something that definitely helps our audience and our listeners. But as far as the unit upgrades themselves, what's the plan as far as what you're going to be upgrading interiorly? And then how much is that going to cost? How much did you budget for just the interior upgrades? And then what kind of premium on the interior upgrades are you projecting on just the upgrades, not the organic side of the rent growth?
No, that's a great question, Dan. So, I mean, typically we're going in, we're looking at the cabinets and seeing if they're in good shape. We don't have to replace the cabinets. We're, staining, refinishing, painting, because those can be pretty pricey. Oftentimes, appliances are kind of a crapshoot. Some of them are garbage, some of them aren't. So we're always budgeting something for appliances. We're trying to, you walk into a place like this, there may be a black appliance, there may be a white appliance from, 1980. We're trying to make a little bit more symmetry there and make them, flow a little bit better. Almost always we're doing flooring and painting. Those are the two main ones, and they're two main ones that get neglected the most. And then improve the lighting. Lots of these units have just kind of some dingy lighting. It's just kind of yellow, just kind of old school type lighting. And then we're going into the bathrooms. Sometimes we're replacing vanities. Once again, it depends. This property was kind of put together as a hodgepodge with, how they were doing the unit improvements. So we kind of put our plan together. It does vary in what we're spending. They're about 920 or 960 square feet. So we're spending anywhere from $3,500 to $7,500 if we're getting a new set of stainless steel appliances, if we're having to go in, change water heaters, do some of the plumbing. So it could certainly vary quite a bit. And we're kind of looking at as an aggregate all over and factoring that into the budget. The premiums varied. So this was kind of a funny time to be going through and jacking people's rents up, and I hate to say it like that, but, we were providing better service, better value, but it was right in the heart of COVID. So, and we experienced really high vacancy during that time. That was from the previous management. We got left with lots of high vacancy. Some of the residents knew there was writing on the wall and that we were actually going to start collecting the rent and, expecting more, kind of getting rid of the less desirable individuals that were causing issues on the property. So at one point we were about, 70% occupied. So at first we were a little bit cautious with the rent increases. Now that we're moving forward for these renovated units, it's about $75 over kind of the baseline. But I would say before then, the overall average was at least 75, sometimes 150 below. Last year, I was just kind of looking at the rent roll, and I think it was about $26,000 a month in collected rent. Now we're closer to 40,000. So if that gives you an idea, we're still moving forward in that. We're still improving the project. Yeah, it's go ahead.
Well, what's unfortunate, and I say that with quotations because it's a successful project, no question, is that because of COVID, we really hit a brick wall when it comes to raising them what we should have. In fact, there's a boatload of meat still on the bone here, but we were still able to raise rents throughout the process and raise the value of the property. But I mean, there's still a lot of meat on the bone still right now, and we're refinancing the property. So COVID affected it still, believe it or not.
Yeah, I would definitely, say it probably affected it in a negative way, even though you still had a positive outcome at this point of the increase in the value of the property. You probably could have done a lot better if COVID didn't hit, obviously.
No question.
So what was the overall budget all in on this property from the beginning for CapEx, interior, exterior, kind of everything?
Yeah. So, with a project like this, this was a joint venture between 4 partners, myself, Chris, and 2 other partners. We kind of have 2 business models. One of them is the syndication model, which we're really focusing on cash flow, providing returns. This one, we're looking at, how quickly can we increase the value of the project? So we are pouring basically all of our cash flow back into the project to increase the value of the project as fast as possible. Our budget was about $200,000, in which we spent. We're continually doing upgrades, and we probably will for the next year or so. What we're refinancing into, Freddie, they're going to hold on to, I believe it's a year's worth of reserves. So we'll use that to continue to upgrade the property. But about $200,000 is what we put into it. And as I said, lots of it comes from cash flow and just the initial raise itself.
So let's talk about the financing actually. And let's first talk about the financing from the very beginning when you first acquired the property, and then we can get into some of the refi stuff at this point that you're kind of working on right now. But from the very beginning, what kind of debt were you able to put on the property?
We went through CBRE, the guy we work with all the time named Craig Branton out of CBRE in Denver. We went through him for a Freddie Mac deal. It was a 310 prepay situation. So for those of you that haven't gone through that, the first year, if you sell or refinance, if you pay off the property, it's 3% of the loan. The second year, it's 1% of the loan. And then after the second year, there's no prepayment penalty when it comes to the loan. That's not a long-term Freddie play. I wouldn't say I would suggest that always as quote unquote bridge debt, because it's kind of acting as our bridge debt. But it made the most sense for us at that time. We were to get interest-only payments throughout the entire time. And we bought another property with this JV group at that same time. And for that, we had a lot of rehab funds. And it just kind of was a collage of purchases. But for this 48 unit here, it was a Freddie Mac 310 prepayment deal.
What kind of LTV did you get on it, or LTC?
80.
So 80%. And did you do this one with some of the CapEx rolled into the loan?
No. So as this loan was for the purchase only, we did not. That's why Colin was kind of joking earlier about the stress that this was, is that we did not, Freddie wouldn't allow a rehab budget for the 310 prepaid loan that we got. So we actually had to come out of raising. We had to raise for a part of the CapEx, and then we had to use our cash flow for it. And it was cash flowing after a while after we raised the rents. But no, we did not have a rehab budget at least given to us. We had to raise it and use our cash flow.
And talk to me about what you're doing right now in the process of doing the refinance. Because if I'm understanding correctly, you have, and since you're now in your second year, you still have a prepayment of 1% there, correct?
Yeah, so we'll have a prepayment of about $25,000. Certainly not the best case scenario. There are a couple reasons why it makes sense to us, though. It's only $25,000. Rates are, if you're paying attention, have actually gone up recently. And we're okay with locking into a 10-year fix with Freddie for 3 years of IO at the rates being about as low as they can get, and dealing with that $25,000. And here's why. First off, we plan to get back even more than we have into this deal and another deal that's part of this JV. So I don't want to make it hard to understand, but basically we're going to get back about 115% of the combination of how much we put in. We put in $900,000 for 2 properties. We're getting back about $945,000. So just that overage, whatever that is going to pay for our prepayment penalty. We're going to have money in hand right away, about $737,000 right now to put towards $35 million that we have under contract right now, spread out over 4 different states. And we're going to lock it into very, very low rates. It's hard to believe that rates would go lower than they are now. So it's better to lock it in now than to wait until October. Let's get $737,000 in our pocket now to put towards that $35 million that we have under contract right now. I hope that made sense of why we're choosing to pull the trigger now and just kind of deal with that $25,000 prepay.
Sure. And what's the usually Freddie is the lender on this one as well? So you're going from a Freddie to a Freddie? Freddie
to Freddie, and they wouldn't. They wouldn't. There's no leniency there. They already sold it to the market, so there's nothing they can do about. Come on, give us a little. We're going right back to you. They don't really care about it. So.
Yeah. Now I have heard recently, and I don't know if you have heard this or not, but Freddie has actually started to lower and in some cases eliminate the COVID reserve. But you're now talking that they're going to probably still have a COVID reserve on this one. Is that because of some of the location or the loan to value that you're getting, or what's kind of the process there as far as the COVID reserve determination?
So Colin loves when I ask a question as my answer to somebody's question, and maybe it's the attorney in me, but I want to make sure I understand what you're saying. You said you've heard or you've actually done it. Have you closed a Freddie deal lately where there was 0 months of reserves?
So it depends on the term. So I've heard that I have not actually done it, but I've heard that there was a release from Freddie that they announced that if you can get to 65% LTV, of course, they will drop the reserve. And then if you are at a little bit higher, say 70, 75%, then they, instead of doing the full 9 or 12 months, they might drop it down to like 3 to 6 months. And instead of being principal and interest, it'll actually just be IO.
So no promises we were given. However, we were told that the hopes would be it's around 9 months by the time we close this refi. And that could be because of 2 reasons. First off, I heard that same thing you did. If we were to refinance at 65%, that they're opening up the opportunity for no reserves. It doesn't make sense for us to get our money back on this to do 65. So because we're doing 75 on the refi, they anticipate there being about 9 months of reserves needed. What we were told, but it's not guaranteed, is that if that changes, so let's say we close in May or June 1st, and then all of a sudden on July 1st, Freddie says, hey, no more is it 9 months. Now it's only 3 months. Well, then we're grandfathered into that, if you will, and we only have to have it in there for 3 months. And that's kind of what we're riding on. Worst case scenario, 9 months, but we find it extremely hard to believe that we're actually going to have our money tied up for 12 months.
We thought that as well last year when we closed the deal in May.
Well, no, I believe that. That was
still got 12 months caught up.
Though. That was at the beginning of COVID. But yeah, you're right. I could be wrong. And we're prepared to hold it there for 12 months. But I'm hoping that this May, a year later, is a little better than it was last May.
Well, you just had to put yourself in the lender's perspective. There's no motivation for them to give it back to you. We don't earn anything. They're not earning anything. It protects them. They have no motivation at all to give you that money back at all. That's the whole thing about that COVID reserve. Now, going back to the COVID reserve, as far as the 9 months or whatever on this particular refinance that you're doing, have you been able to negotiate it being just interest only, since that's what you're getting for the first 3 years, or is it going to be both P and I?
At this time, it's P and I. Maybe I'll have Craig talk to you and you can negotiate me an interest only reserve thing. I didn't know that was an opportunity. They seem pretty set that it's going to have to be P and I, but and
maybe you can negotiate that at least.
Well, look, the worst case scenario, they say no, right?
Right, exactly.
But I mean, I think that another thing that could affect this is that it's Omaha. And not only is it Omaha, it's Papillion, which is a suburb of Omaha. So how they would do this, if it was Denver proper or Atlanta or DFW or whatever, that could also change depending upon we've had our location sometimes gear those or guide those debt terms and leniency, if you will.
So let's talk now about the investor side. I know you mentioned being kind of like a JV deal instead of more of your typical syndication. So walk us through what you did to be able to obtain the equity to acquire this property.
This was a JV deal. We structured it with a parent LLC that at the time of purchase, it was purchasing a 23 unit. It was purchasing a 48 unit. And since then, it's also purchased a 26 unit. It's the same group of investors. So the 900,000 that was put in at first bought a 23 unit and a 48 unit. And that was actually when divided up between 4 members, really. And that was an individual that put in 22%, another individual that put in 20%, Colin. Basically, if you either put in 20% or you put in 11%, and that was just a handful of people. And then we also structured it, Colin and I structured it this way, where an entity that Colin and I own also was an 11% member. And we received that equity from borrowing it from the other investors. So they lent it to us on a personal guarantee, and that was our entity's 11%. We both put in our own money as well, but that entity that owned 11% was borrowed money from the other investors, and we've been paying them monthly on the interest only on that loan. And that's kind of how we that's how we got a little creative with building a little more equity. We also receive an asset management fee, but that's how we build up that equity.
That definitely is very unique and very different than what we've seen in the past for some of these other guests that we've had on the podcast. So it's good to kind of break that down. How did you find these JV partners?
Well, one of them, so Collin started a real estate meetup here in town, here over 2,000 members now in Omaha, the Omaha Real Estate Meetup. And one of them was just somebody who was attending those. We get along very well with him. He's an agent in town here and just someone we get along well with. And so he was certainly interested. Another one reached out to Colin from a Bigger Pockets posting that Colin had. Colin, like once a year, throws out like one posting on Bigger Pockets, then gets like #1 trending for like 7 days or something crazy. And they're very well written posts. And I think his first one was like 40 units in 4 days. And then the next one was like, it's just great commentary. It's great. So a gentleman in California read it. He's a doctor. He likes what he does. He's not trying to get out of that, but he wants some passive income for his family and just kind of supplement his income. And he reached out to us and said, I like what you're writing on Bigger Pockets. Talk to me about it. And we kind of explained to him what our goal was. And I mean, since then he's invested in a number of deals, not only in additional JV deals that are under that umbrella, but he's also invested in coming up on 2 other syndications that we've run as well. So that's how they found us. Oh, the other one's my dad and the other one's Colin's mom. So that's how they found us.
I was gonna say, how did you find those people? So anything else that you think might be interesting for us to talk about this acquisition that we haven't really touched on yet, that might be interesting for us to kind of unpack for our listeners?
Here I am talking still. Colin's either doing this on purpose or gonna.
I'm sure Colin probably has some like property management stories we could talk about on this property, right?
Yeah, no, absolutely. So as I kind of alluded to, going through COVID, and then having a high vacancy, that this property, we experienced some additional challenges at first. So really, it was just kind of a coordination of the team getting down there. And I know it sounds, kind of cliche and whatever, but we just focused on the customer. We were there every day. We had our team there every day. We would never let a maintenance request go more than probably 6 hours without a response. And I mean, 6 hours response and fixed. We were scrappy, aggressive to get those residents in there. We were offering, some leasing bonuses to lock people into 18-month leases for residents that we know that had paid, that had been there for a while. We started doing a lot of additional advertising, using my Meetup group, posting about that, really being aggressive on finding those residents. As I said, because that stretch right there was, those first 6 months is your reposition period, or at least really where you get the momentum. And then with COVID hitting, we kind of went into full gear. So I don't know if there was any secret sauce, but we didn't treat it. We treated it like our own home, and maybe even better. As I said, we ran into a lot of different difficulties as far as, some maintenance issues that came up, which our team rectified immediately when we took care of the residents. But it's amazing the turnaround. As I said, we had 18 vacancies at most at that. And that was last year. I think that was in March. So it really was kind of a time of like, all right, are we gonna get it done, or are we gonna fold like the rest of the world is saying that we should? And we just decided, I guess, buck up is the best way to look at it.
I think we lucked out here because with it being a JV situation, and you can structure with the syndication this way as well, but with the JV being a little more intimate with the people, our investors, we were able to invest in these apartments without an expectation that there'd be payouts monthly or quarterly. Everyone knew that the goal here is to refinance as quickly as possible. And we did the 23 unit within 12 months, and we got back more than we put into it. And now we're doing this, and we're doing well on this 48 unit as well. That helped, right? If it was a syndication and people were expecting payouts, not that they need to be, you can tell your syndication investors that there's no payouts for 2 years. It's just, it can be harder to gather those investors. But I think that really helped us there is that it's a much more tight-knit investor group that they weren't after cash flow. They were they just want the same thing we did, refi and then roll that money onto the next one. And that's really helped set this up from the get-go as we're on the same page.
Did you have to do any capital calls?
Colin's shaking his head. We did have to do one capital call, but that was literally within the first 7 or 10 days. And that was because of look, I have no problem admitting when I made a mistake, unless I'm arguing with my wife, then I've never made a mistake in my entire life. But I'm joking. She's usually right, though. But it was in the first 7 or 10 days, and it had nothing to do with our calculations. It was actually not our fault. It had to do with the calculations of closing and what the banks were expecting, and it was kind of a miscommunication there. And it was a very, very small amount. So a $200,000 investor had to put in another $10,000. And luckily it wasn't that big of a deal.
Yeah. So what about property management? I know you mentioned, Colin, about, you having your team down there. Are you guys doing kind of are you vertically integrated? So you are doing your own property management, or do you still have a third party, but you're just managing the manager?
No, we are the third-party property managers. So right now we're managing about 450 units, looking to scale to probably 800 this year. So we have a full team. We have a maintenance staff. We have leasing agents, receptionists, office managers. So we are vertically integrated. We do obviously use a lot of subs. Some are preferred subs, which almost work exclusively for us. So they do some other side work, but yeah, we are vertically integrated.
And you mentioned earlier on this one that you had an asset management fee. Is that correct?
We get an asset
That is
management
correct.
fee. Yep.
Okay. Now, is that fully encompassing of the property management fee, or is that in addition to the property management fee?
It's an addition.
Okay. So you have a property management fee, which is typical. And what's that percentage on the property management side?
That is 7%. We don't have payroll costs, which so we basically factor in our marketing, payroll, and just create a flat fee. I know in a lot of other places they may say they charge 4%, but then they have a payroll cost and then they have additional charges. We just roll it in. And the reason being is that since I'm an investor into the project, my interests align. So basically trying to find a point where I can make a small kind of livable profit, pay my people, and just cover the overhead. So.
No, I think that's definitely reasonable for a property that doesn't have on-site management, or is there on-site management on this one?
No, there's not.
Okay. So that definitely makes sense from a non-staffed or non-on-site property manager, because most of the time when you see the payroll, there's actually somebody actually is full-time on the property, or you have somebody who might be floating between a couple of different properties or something like that. So I'm not opposed to the 7%.
So should I charge more? Is that what you're saying, Dan?
I think you probably could.
Up a point or two. Okay, perfect.
I think you probably could, especially with, I don't know what the market rate is there in Omaha, but if you were to try to source a third party, and this is where the challenging part is, right? Because right now you are part of this kind of JV partnership and you are kind of one of the owners. So you can pretty much set whatever you want, but to be fair to the other owners, you could go out there and say, okay, I'm going to get like 3 other property management companies to bid out what they would charge me to manage this, right? And then that way you can kind of base your fee off of what the market is telling you, and then you present to the owner saying, hey, this group is charging 12, this one's charging 8, this one's charging 10. Well, I'd like to increase my fee to 8.5 or 9 or whatever. And they have data to support it. That where you start to get into issues is when Colin just says, I'm raising it to 10, and he has no data to back it up. And he's just thinking he's trying to like pat his own pocket,
Yeah, and here's the deal: the property management's never going to get me rich.
Right.
It basically is kind of it keeps the lights on, but it's my value add. So all of us, Chris is great at sourcing deals. He's great at underwriting. Doing the property management is my value add portion. It's where I put the work in. Creating a team, managing that team. So if I get paid a little bit from it, but that is not where the wealth's going to be made. It's in the real estate itself. So.
Yeah. I just know it's a lot of work, and I know you do too.
Yes. Yes.
Yep. So I have two final questions for you, and either one of you can answer either one of these questions. They're kind of contrasting questions. The first one is, what did you find was easier during this entire acquisitions process that maybe originally you thought was going to be a little bit more challenging?
For the acquisition of the Vincent?
Correct.
I suppose the speed at which we got under contract. I was used to dealing with 14 emails going back and forth between agents trying to get the exact number patted down. And to be honest, we had a hungry seller because they thought they were going to have hundreds of thousands of dollars in their pocket, perhaps millions in their pocket just a couple of weeks before it fell through. And so I was surprised to see that when we said 3.15 or 3.13, we'll sign it right now. We got what we wanted right away. And I was expecting a little more pushback.
Yeah. And so the opposite of that one is, what did you find that was a little bit harder or more challenging that originally you thought was going to be kind of like a walk in the park?
I guess for me, it was the initial reposition process. We always go into these projects with a plan of, okay, months 1 through 3, we're going to rehab these units. We're going to increase the rents here. We're going to focus on by sections. And then, COVID kind of put a little kink in that where, going through and raising the rent on 16 units April 1st may not look the most kind to do, and when there's all sorts of uncertainty. So that was the challenge, and it just required us to refocus and, focus on good management, and, actually providing that value. So that was probably more mentally difficult than anything, of just trying to assess and see where the whole market was.
Well, Chris, Colin, thank you so much for taking some time out of your busy schedules to be with us today and sharing a lot of these golden nuggets around this acquisition. I know it's been challenging, but it's definitely going to be rewarding, especially after you finalize this refi. How can the listeners reach out to you if they have further questions for you about this acquisition, or maybe they want to join you on one of your future acquisitions?
Yeah, our website's parkavinvesting.com. The name of our group is Park Ave Capital, but the website's parkavinvesting.com. You can find us on email at Chris at Park Ave Investing or Colin at Park Ave Investing, Colin at bricktownmanagement.com. We're on LinkedIn. We're on Facebook. Those are the easiest ways to get a hold of us for sure.
And maybe bigger pockets. You can catch one of those Colin posts.
Oh, you'll see it. You'll see it.
Episode 318. Just be prepared to be wowed. It's phenomenal. A year into investing, full of nuggets. So, yeah.
Awesome. Well, thank you, gentlemen, so much for joining us here. Looking forward to continuing to follow you as you continue to close more deals here in 2021, and looking forward to having you on a future episode of our podcast.
That'd be great. Thanks, Dan. Thanks for having us.
Thank you.
Thanks, Dan. Appreciate it.